All right, let's take a look at this excellent example. We got 30-year fixed rate residential mortgage. Unless you're told otherwise, when you see mortgage, general rule, you think amortizing, okay, absent any other information. But it could be non-amortizing, which means interest only, but they'd have to specify that all the principal's repaid at maturity. Okay, if it's amortizing, the cash flow that's going to be received each period is going to be principal and interest. Okay, so as the cash flow that you receive, as the cash flow received goes up, your reinvestment risk, you have more cash each period to reinvest, your reinvestment risk goes up. Okay, but the good news is credit risk goes down because it's not like you got to wait theoretically 30 years. Hopefully, that homeowner then has set aside enough money to pay off that debt. Okay, so there's less credit risk because the homeowner's paying off the principal on that loan little by little versus a bond issued by a corporation, a 10, 20, 30-year bond. How do I know that company's going to be around 10, 20, or 30 years, whatever it is, to pay off that debt? All right, so the home costs $500,000. All right, so how are we financing the acquisition of this house? All right, $400,000 is debt. Where did we get the rest of the money from? Well, then 500 minus the 500, and that's an ugly E, that was equity. 500 value of the house minus 400, that's borrowed. The other 100 is coming from equity, our own funds. All righty, so the present value of this loan, 400,000, dropping to zeros. Now, it's 360 months, 30 years, but if we're making our payments monthly, if it's monthly pay, then the 30 times 12 months per year, 360 payments. Okay, now your interest rate, 3.5, but we got to divide that by 12. We want consistency. What's my monthly rate? Okay, so take your 3.5 divided by 12. 0.291667%. That's a percent, folks. All right, so that we need consistency monthly. All righty, now we're solving for, hey, what's going to be our payment? What's going to be our payment? So now our payment, 1796.18, 1796.18. Okay, so that is our monthly payment. And every time you make a payment, you got to separate the principal versus the interest. All right, so payment number one, let's do it. You take the initial carrying value of the debt. All right, we're going to subtract that from our payment, and the balance is the principal. So payment number one, and that should be 0.18. Sorry about that, folks. 1796.18. Initial carrying value of the liability, 400,000. We haven't made any payments yet. So the initial carrying value, 400,000, times 3.5 over 12. How much of that first payment is for interest? Most of it, 1166.67. The balance is principal repayment, 629.5. Okay, second payment. Payment number two, no change, 1796.18. Now the carrying value of the liability has gone down. Okay, so now it's 400,000 minus the first payment towards interest, 629.56. 629.5. That is now the carrying value of the liability at the beginning of the second month. Multiply that by 3.5 over 12, your monthly rate, 1164.83, 1164.83. So notice the payment towards interest went down. So that means what we're allocating towards principal went up. The second principal payment, 631.35, and so on and so on. Okay, this is our amortization spreadsheet. You could do this over all 360 months, okay?